Welcome to Business Talk, where we're having a conversation with Wendy Myers, Head of Securities at PSG Wealth, all about markets. And when stock markets start tumbling or rising irrationally, like we see sometimes in the crypto space, look at Dogecoin, for example, and we see daily injections of good or bad news. It may sound like it will never end or it'll never stop, and it can spark anxiety, it can spark euphoria. And I think the bottom line is that often it can trigger radical decisions and knee-jerk responses that are not the best in the moment. And panic, as we know, isn't a strategy. Wendy, great to chat again. And it's so important when markets get choppy to understand what volatility is all about. And markets are volatile and they're unpredictable. So what does this mean for investors?
Thanks, Michael. I think, investors should be very conscious of the concept of volatility. Obviously, we know that markets don't stay stagnant. They rise and fall in response to the stock's performance financially or external factors in the market. I think it's important for investors to understand sort of what is acceptable from a volatility or price move perspective. And certainly in stable periods, the JSE and the S&P 500, if you're thinking of offshore markets, they can gain and lose less than 1% a day. And that's really quite palatable for the investor. But you'll find that there are times, think COVID, where the market experiences really dramatic price changes. And that's what we term volatility. Often volatility can be a sign of trouble for a particular stock, but it really is an inevitable part of long-term investing. And I think it's important for investors to understand it's part of the world of being invested in equities. And so you need to understand it. You need to understand what's palatable in relation to your portfolio. I think it's important to know that markets typically can see volatility of about 15% from average returns during any given year. But in any sort of 5-year period, you could see the markets go down 30%, which is what we saw in COVID, if not more. And if this is a concern for you as the investor, I think it's really essential to sit down and decide, do I want to have a pure equity portfolio? Because it can be scary. But I think the point is that market volatility is very much a typical part of investing. And as long as you invested in solid companies, your portfolio will always recover in the medium term, maybe not so much the short term. And we've always stressed, Michael, that in the long run, equities have always been the preferred asset class to deliver inflation-beating returns. So they're a necessary part of your portfolio. And I think you need to also consider maybe multi-asset funds, which might have a more conservative response to market fluctuations, and even some fixed income investments. And that can offset some of the volatility that your portfolio may have in times of volatility. And I think the key thing, Michael, is just finding that balance that works well for you personally. And that's the key point that I think investors should take out when considering market volatility.
It's such an important point you raise about finding out what works for you, because I think everyone's idea of risk or volatility or, how you respond to these kinds of things is different. And, if you're the kind of person who, when you see a 15%, 20% drawdown, is going to battle to sleep at night, if it's going to impact your personal relationships, if it's going to make you cranky and anxious, all of that kind of thing, then clearly, even though you may know all of these things, to your earlier point, then that isn't the, high equity portfolio is not for you. Maybe something in a more conservative multi-asset type portfolio. But I think the important thing is knowing up front that you've got to be bracing for volatility. Yes. It's almost like when you get on the roller coaster, knowing, okay, this is going to be the anaconda. I know what I'm in for, and not being shocked by it, because that's when you have that knee-jerk response. How should investors handle market volatility when they're in it?
I think, the key message I want to leave today is don't panic sell. Companies can sometimes respond to external factors, and then you might panic and sell that stock, and then the next day or in a month's time, they have fantastic results that are published and the stock goes up 10%. So I think there's a few guidelines that I'd like to give investors to consider if market volatility is a concern. I think to try and time the market is never advised in equities. No one has that crystal ball. I wish we could all have it. We wouldn't be doing 9 to 5 if that was the case. And I think another important point is to really remember you are invested for the long term. Stick to your plan. We can talk later on this, but this is really where an advisor can help you. And I think in a key takeout, this is one of my favorites actually, is to see volatility as really a positive opportunity to enter the market at attractive entry levels. Some people have done extremely well in seeing volatility as positive. I think Warren Buffett is one of the most successful individuals from an investing perspective. I think he's had a few quotes to say, when others are fearful, this is the time for you to start investing. Also have an emergency fund of cash. That's really a cash pool that is available to you to enter the market when you feel the share has bottomed. Please remember that, as I said, you can't always time that bottom. So you might find it goes slightly more down after you've entered, but don't panic about that. Just keep invested. And then I think also we've spoken about this a bit last year, Michael, is to look at rebalancing your portfolio. And that is more to say, given my current risk profile, how do I make sure that my portfolio is well structured to make sure that I'm comfortable with the level of volatility that I'm seeing in my portfolio?
I think that's such an important point, because a sudden drop in the market can have a dramatically different implication if you're just starting your career, just starting investing, compared to someone nearing retirement. So what's important when you look here at your financial plan, are there ways to minimize your exposure to large portfolio gains and losses?
Yes, they most definitely are. I think a key point to always remember is that we always stress how equities is the single asset class that beats inflation. And we've spoken last week about the need for portfolios to be robust enough to deliver inflation-beating returns, especially in retirement. And I think also never underestimate the importance of having a balanced portfolio. So not just single equities, have exposure to multi-asset funds and fixed income that I've spoken to previously. It brings peace of mind as part of your balanced portfolio. And I think there's a few key points that investors can consider to minimize portfolio losses. And I think my favorite are just making sure your portfolio is well diversified. For example, think of the weighting across different sectors and industries. Ensure your stock selection has a high dividend yield. And these stocks typically don't have high volatility, because remember, a lot of investors are investing in that stock for the dividend, so they're not going to panic sell. They're happy with any kind of volatility in that stock. And I think avoid the panic sell. We've spoken about that. There are many, many examples that come to mind. I think NVIDIA was one of the recent ones where one of the hedge fund investors was saying to not trade the stock, just buy and hold for the long term. And we've seen some interesting movements in that stock price over the last couple of months. And I think consistently adding additional money to your portfolio, that definitely helps you in benefiting from low entry levels when markets are down. And don't underestimate the importance of having ETFs in your portfolio to assist with those balanced returns, as opposed to being single equity investments only. And then finally, just remember to keep emotions out of it. Some people say don't look at your portfolio too frequently, but just remember that you're in for the long term and you're going to stay the course.
To keep your emotions out of it is sometimes easier said than done when you're talking about a 40-year-old with a couple of million rand that they've saved and they're hoping to grow this into retirement or turn it into that perfect nest egg or whatever it is. And that's, I think, where the financial advisor can certainly play a role. How can a financial advisor assist you when considering market volatility and to help you keep those emotions in check?
Yeah, I think they can play a very effective role. I think one of the key ones is really defining your risk profile upfront, because then you can design your portfolio to make sure that it meets that risk profile. It's difficult to do that on your own. This is where the financial advisor really, in my opinion, adds value, so that from the outset, the volatility that you see, is within your tolerance levels. They can guide you on the mix of stocks. If you think of investing, certainly in the offshore markets, everybody loves tech. And the tech stocks have really delivered some amazing returns if you've been invested in the right ones. And so, you can quite easily, if you're investing on your own, want to be more biased towards tech, but that's going to drive big volatility. We were chatting earlier, Michael, around some of the recent volatility in Tesla as an example. So a much loved stock is now coming off recent highs. So I think it's important for the advisor to guide you on the mix and the sectors. Obviously, you want those high dividend yielding stocks. You want to also make sure that you're not exposed to those stocks that drive volatility. Think of those growth stocks which don't pay dividends. They can typically be quite volatile. And then, I always talk about the split of local and offshore. It's extremely important from a rand, I suppose, hedge perspective, that you want to have some money invested offshore, and then decide how much is your cash pool to be held in your portfolio. We spoke last week about really cash is good because it gives you the ability to enter the market, but remember, it also impacts the performance of your portfolio. So you don't want to have too much cash, because then you might not achieve your inflation beating returns. And then I think continue investing. Keep to your plan. Keep reviewing your portfolio. Make sure it's delivering to your expected outcomes, and talk to your financial advisor about all of these factors, and they can really give you solid advice to set you up for success in the long term.
No, but I love that one earlier. You said, don't panic. The Douglas Adams of investing advice from The Hitchhiker's Guide to the Galaxy, one of my favorite books. Wendy Myers, Head of Securities at PSG. Well, thank you so much. Some great advice on how investors should navigate volatile markets here on Business Talk.
Thank you, Michael.